Welcome to the deep dive. We're here to give you that shortcut, slicing through the dense financial filings to pull out what really matters.
Exactly. And today we're digging into the travelers companies, PRV, big player in property casualty.
Yep, looking at their Q3 2025 performance straight from their latest 10Q.
Right. And the mission, as always, isn't just reading numbers. It's about getting behind them. What actually drove the results? We're talking underwriting, investments, capital, the whole picture.
And the headline number this quarter, it's pretty staggering. Net income just soared 50% year over year for Q3.
50%, that's huge.
It is. $1.89 billion compared to $1.26 billion last year. And per share, diluted net income hit $8.24. That's up 52%. They're absolutely crushing it.
Phenomenal result, really. But, for anyone watching P&C, the immediate question pops up. Is this real operational strength, or did they just get lucky with the weather?
Good question. Was it just a quiet hurricane season?
Exactly. And the first place you look for that answer is always the combined ratio.
Right. That's the key metric, isn't it? Tells you if they're making money from the actual insurance before investments kick in.
Yep.
So what's the story there?
The story is combined ratio, that's losses plus expenses divided by premiums, it improved dramatically, came in at 87.3% for the quarter.
87.3%. Wow. What was it last year?
It was 93.2% in Q3 2024. So that's a drop of 5.9 percentage points. I mean, that improvement, that's basically the engine driving this whole quarter story.
Okay, 5.9 points. Let's unpack that. Because, like you said, weather's the big variable. How much of that drop was just fewer big storms? Good luck, essentially.
Yeah, and that's where the details get really interesting. A big chunk of it was from lower cats, catastrophes.
Okay, how much lower?
Significantly lower. Cat losses dropped from $939 million in Q3 last year, way down to $402 million this Q3.
Wow, less than half.
Right. And that difference alone, it accounts for over 5 points of that combined ratio improvement. Think about it. Last year, cats added 8.8 points to the ratio. This year, only 3.6 points.
Okay, so that explains a lot of the headline improvement. But what about the core business? If we sort of strip out the weather volatility, the luck factor.
Yeah.
How did the underlying business perform?
That's the crucial part, isn't it? And yes, the underlying picture looks strong too. This is where you see the management execution.
So the underlying combined ratio.
Exactly.
Yeah.
That improved by a solid 1.7 points year over year in Q3. And that wasn't luck. That was driven by, well, two main things.
Okay.
First, the benefit of earned pricing. All those rate hikes they've been pushing through, they're finally earning into the results. And second, they saw genuinely lower losses in personal insurance.
Okay, so real operational gains there. Now, I did spot something going the other way, though. A small headwind. Didn't they release less money from old claims reserves this quarter?
Good catch. Yes, that's right. The net favorable prior year reserve development, that's money set aside for claims that ended up costing less than expected. It was much lower this time.
How much lower?
They only released $22 million in Q3 this year. Compare that to $126 million in Q3 last year.
Okay, that's quite a difference.
It is. So think about it. If they'd released the same amount as last year, that reported 87.3 combined ratio, it would have been even better. They actually overcame that headwind through stronger core performance.
Right. That puts the underlying improvement in an even better light. And it perfectly sets up looking at the segments. If execution was key, where did they really shine?
Yeah.
Has to be personal insurance, right?
Oh, absolutely. Personal insurance or PI. It went from being, frankly, an industry-wide headache for a while there to just a powerhouse this quarter, a really explosive recovery.
Explosive how? What were the numbers?
Segment income more than doubled, jumped 110% in Q3, pulled in $807 million.
Wow, 110%. That's quite the turnaround. And the combined ratio for PI?
Stellar. 81.3%. That's an improvement of 11.2 points compared to last year.
Okay, 11 points. Was that just them jacking up rates on homeowners and auto policies?
Well, pricing was definitely part of it, especially you saw that in the homeowners and other lines. But it wasn't just that. The underlying combined ratio for PI improved by a very strong 5.0 points.
5 points underlying. Okay.
And what's really key here, I think, is the improvement they noted in the automobile line. It suggests that those awful trends in auto claim severity and frequency, the ones that hit the whole industry, they might finally be stabilizing, at least for travelers.
So their rate increases are finally catching up, or maybe even getting ahead of the actual claims costs in auto.
It certainly looks that way. Their pricing actions seem sufficient now for the current loss environment there. Big relief for them, no doubt.
Okay, huge turnaround in PI. What about the other parts of the business? Bond and specialty insurance, BNSI, that's usually their steady performer, isn't it?
Yeah, BNSI is just remarkably consistent and efficient. It actually had the best combined ratio of all the segments this quarter, 81.6%.
Even better than PI.
Just slightly, yeah. It's a high-margin, predictable business. And interestingly, it had the most favorable prior year reserve development. They released $43 million in Q3, mostly from Fidelity and Surety lines. Just a really high-quality segment for them.
Steady Eddie, okay? And the big one, business insurance. Yeah. BI, that's the largest chunk of the company. Did it, pull its weight?
BI had a solid quarter, too. Segment income was up a healthy 30%, and the combined ratio came in at 92.9%. So definitely contributing positively.
92.9, not bad, but not quite as strong as the others.
No, and this is probably the point where we have to talk about those long-tail risks you find mainly in BI.
Ah, yes. The ghost in the machine, as you sometimes call it. Even in a quarter this strong, BI is where those legacy liabilities like asbestos tend to show up.
Exactly right. BI did its annual asbestos reserve review this quarter, and pretty much like last year, they had to add a significant amount to those reserves.
How much this time?
$277 million added in Q3, very similar to the $242 million they added in Q3 of 2024.
So nearly $300 million chunk taken out for asbestos. Again, that's not insignificant.
Not at all. It shows this isn't some, historical artifact. It's an ongoing cost impacting current results, even in a great quarter overall.
That's really important context. Okay, let's shift gears a bit. Underwriting was strong, but the other side of an insurer's profit engine is investments. How did that look? They invest all that premium income, the float.
Right, and investments were definitely the other major tailwind this quarter. Net investment income, or NII, was up 14% year over year.
14%. Nice jump.
Yeah, it hit $1.03 billion for the quarter.
What drove that? Were they taking on more risk, chasing yield in weird places?
No, not according to the filing. It was mainly driven by two pretty conservative things. First, just a higher average amount of fixed maturity investments, basically, a bigger pool of bonds. And second, higher average yields on those bonds, reflecting where interest rates are now.
So more money invested, earning slightly higher, but still conservative rates.
That's the picture. Their portfolio is overwhelmingly conservative. Total investments are about $104 billion, and 94% of that is in fixed maturities and short-term stuff. Pretty plain vanilla.
Okay, but if they're mostly in bonds, rising interest rates must create some paper losses, right? I saw a mention of a big unrealized loss number, something like $2.5 billion.
Yeah, $2.48 billion. Pre-tax unrealized loss. It sounds alarming, but you have to understand what it means.
Okay.
The filing is very clear. They consider this loss temporary. It's purely because interest rates went up, which pushes down the market value of existing bonds. It's not because they think the bonds won't pay back. It's not credit risk.
So as long as they hold the bonds until they mature, they expect to get all their money back and this paper loss disappears.
Exactly. They generally intend to hold to maturity. And their portfolio duration, a measure of interest rate sensitivity, is pretty moderate at 4.6 years. So while rising rates hurt the market value short term, it's managed.
Got it. Okay, that makes sense. And just quickly on the top line premium growth, was the overall business expanding?
Steady growth there. Earned premiums were up 4% in Q3, hitting $11.14 billion.
4%. Was that concentrated anywhere?
No, what's nice is it was pretty consistent across the board. BI up 4%, BNSI up 3%, and PI up 4%. So broad-based growth, which is a healthy sign.
Okay, good performance, steady growth. Let's look at the foundation.
Yeah.
Capital management. How's their balance sheet? Could they handle, say, a really bad hurricane season next year?
Yeah, their capital position looks very solid, well within their targets. The debt to total capital ratio was 22.7%.
And their target ranges?
They stated it as 15% to 25%. So they're right in the middle, very comfortable. And interestingly, if you strip out that temporary unrealized investment loss we just talked about, the ratio actually drops to 21.6%, even stronger.
Okay, so the core capital is robust. What about ready cash, liquidity at the holding company level?
Very strong there, too. They reported $2.84 billion in liquid assets at the holding company. That's way above what they estimate they need annually for things like interest payments and shareholder dividends. Plenty of cushion.
With all that strength and profitability, how are they treating shareholders, returning capital?
Oh, yeah. They returned a pretty significant chunk in Q3 alone, $878 million.
How was that split?
Mostly share buybacks, $628 million there, and then $250 million in dividends. But the really interesting part is what they're planning next.
Okay, what's the plan?
They're signaling a much more aggressive buyback plan for the near future. They expect to repurchase about $2.9 billion in shares over just the next 2 quarters, Q4 of this year and Q1 of next year.
2.9 billion in 6 months. That's a huge amount. Where's that coming from? Is this tied to that strategic move they announced?
Exactly. It's directly linked to their big decision to sell most of their Canadian business.
Right. They're selling the Canadian personal lines and most of the commercial lines business to Definity Financial, wasn't it?
That's the one. For about US $2.4 billion, they expect that deal to close in the first quarter of 2026. They're only keeping the surety business up in Canada.
So they streamline the company, get a big chunk of cash, $2.4 billion, and they're basically telling shareholders, we're going to give a big piece of this right back to you quickly through buybacks. About $700 million of the $2.9 billion buyback is specifically tagged as coming from those sale proceeds.
Precisely. It's a very clear capital allocation strategy. Simplify, get cash, return value.
Okay, so let's try and wrap this deep dive up. The big picture for travelers in Q3 seems to be really strong performance, driven largely by fewer catastrophes, yes, but also genuinely good underlying results, especially that huge bounce back in personal insurance.
Yeah, and boosted nicely by solid, reliable investment income, too. The execution story definitely holds water when you look at the underlying numbers.
But there's always a but, isn't there?
Well, maybe not a but on the quarter itself, but that recurring theme we touched on in business insurance, the long tail stuff, that does hang around.
Right, the asbestos reserves. The fact that even in this fantastic quarter, they still had to put aside another $277 million for asbestos claims from decades ago. That's pretty striking.
It really is. And their total net asbestos reserves, still sitting at $1.45 billion as of the end of September. The filing is quite explicit, too. They say the ultimate cost is just incredibly hard to predict. Complex lawsuits, new legal theories popping up.
So it's not just history. It actively affects how they set reserves today and impacts the BI segment's profitability right now.
Exactly. It's a constant factor.
Huh.
Which leads us to that final thought we want to leave you, the listener, with.
Right. Think about this. You see these large recurring charges for things like asbestos quarter after quarter, almost regardless of how well the main business is doing. So the question is,
how long can these legacy liabilities continue to sort of complicate the picture? How long will they keep impacting reserve estimates and muddying the view of forward performance for a modern P&C giant like Travelers, even when they execute nearly flawlessly on the current business?
It's that long shadow, isn't it? The cost that never quite seems to go away.
Something definitely worth thinking about.
Indeed. Well, we hope this deep dive into the Travelers Q3 10Q gave you the clarity you needed on what really drove their quarter. Thanks for joining us. We'll catch you next time.